Welcome to my channel. I'm Dr. Romano. Today's video, I'm going to walk you through on what needs to be improved in the hedge fund industry. So before we continue, who am I? Well, I'm Dr. Hedge Fund. I have a PhD in financial management and leadership. And I wrote over 900 something pages on hedge fund selection and operational due diligence of a funds of funds. Why would I be making this video? Is because I want to point something out. In the 08 and 09 financial collapse, we did not have so many hedge funds trading back then. And by the year 2000, people started asking, well, what's a hedge fund and why were they becoming so popular and so forth. And it seemed like back then, the hedge funds were outperforming investment banks. So before the year, probably around 2000, it was normal to take your capital and invest it in investment bank investments. However, by the year 2000, the mergers and acquisitions of the 1980s and 1990s, all those people who were in their 40s and 30s, they had knowledge on how to trade and they had connections to a lot of money. Those people went off on their own and they created the hedge fund industry to the extent that we knew it by 2007. Okay? Just hold that thought. And the whole excitement was to become a hedge fund investor and invest your money and gain a lot of money. But back then, investors really didn't know how to invest in a hedge fund or what type of hedge fund to look for and so forth. And unfortunately, just because a hedge fund has low returns, such as 5-7%, that's not a reason to say that they're a safe investment. It's not true at all. Because the ones with 30-40% are also a safe investment. It just depends of their risk profile and the markets that they trade in and the strategy that they actually use, even though they don't actually tell us. Because it is a secret, that's their strategy and so forth. Before we continue the video, please remember to subscribe to my channel. It will really help me out. You're going to get my videos anyway. And please do thumbs up. It really helps me out on every single video. Thank you so much. It's right there. Just press the button. Today, so what should have happened? Unfortunately, as of today, you have once again, the large investment banks merged together. It became even larger. And you have something that can be an extremely unbalanced market. And also the large hedge funds, the top 10 hedge funds, have become so large because they've been around so long that things could get very unstable. When you have a single hedge fund manager trading and that person is doing pretty much everything, that type of person is a true entrepreneur, okay? They went off on their own. They were fed up with trying to find jobs as a trader. Every 2.5 years getting fired or laid off. According to the Book of Occupational Titles, the average person lasts between 2.5 years to 5 years at an investment bank. And a trader has an even shorter amount of time that they're there, because if they screw up, they get fired, and there's just a whole bunch of stress that's actually not necessary. So at the investment banks, their returns are so watered down and they don't follow the markets, meaning that it doesn't make sense because this year you should have made this amount, but yet they didn't. And because of that, you have so many people trading in one particular group that it actually waters down the entire group's average return. Now, this is another reason why large hedge funds have watered down returns too. It has nothing to do with the fact that they have so much money and that they actually have to be conservative. So for an investor to say that, you're ignorant, and I'm going to use that word. Now, the reason why they have watered down returns and their returns are puny is because they have too many traders trading within the same company, okay? So my analysis is that a market, a financial market, will become more efficient and balance out its ups and downs if we had thousands of more traders trading. And so because of TD Ameritrade and all those trading platforms that literally put out the stockbrokers of the 1980s, remember how much stockbrokers used to make? In that type of industry, you were very lucky to get that job. You either knew the mayor's son, or you went to school or dated the mayor's son, or whatever it was. That's how lucrative those positions were, just like the positions at investment banks, how lucrative they are on the trading floor where I used to work. I know the difference between a hedge fund manager who's a trader and a trader at an investment bank who's a trader and a trader at the top 10 large hedge funds. Now, there is a huge difference. And for you, the investor, the first thing you must look at is how big that company is, okay, number one, and how many traders there are trading. That's number two. The more traders they have, the more the returns are watered down. It's not a safer bet because they have a couple people trading. No, you don't think like that. If you want a safer bet, or you invest in a funds of funds, if you have $1 billion, let's say, you could invest in 10 funds of funds because you could put $100 million in each of those funds of funds and let those fund managers manage the capital. And in that fund of funds, in each of those, there should be at least 8 to 10 hedge funds. There is a magic number on how many hedge funds they are supposed to have before their returns actually get watered down. Now, the whole reason why I'm making this video is because we need, as a society in America, not the rest of the world, in America, we need more financial traders trading on the stock market, on the equities market, on the commodities market, whatever type of market it is, we need more. We don't have enough. And what happens is, investment banks, for whatever reason, they're ill-equipped with allocating capital. We've already seen that in the cryptocurrency collapse as we speak. You can't all invest in an industry all at the same time, because what happens is when it goes down, when it goes up, it goes down even faster. Secondly, the equities market and the commodities market is a better market to invest in because you're buying real assets in a way. You're buying a little tiny fraction of that company that's producing a good or a service or whatever it is. A cryptocurrency trading group or a fund like that in cryptocurrency, there honestly is no reason except that people like cryptocurrency that it's going up or down. And originally, when cryptocurrency was used to hide and launder money, it was actually worth investing in because it had value, because people were doing those type of transactions which allowed them to do what they needed to do, whether it was bad or not, honestly. And so what we need for larger hedge funds to do, okay, we actually need the SEC to pass regulations for this. The SEC, number one, has to recommend a minimum threshold for a hedge fund. They also have to pass laws and regulations for the investment banks on how much they could allocate to one fund. And this is very important. Because of the investment banks have so much capital, because they merged together in the 08-09 period and the 1980s and 90s, which made them so big, there's a great efficiency. It's about to happen. You cannot have a handful of people allocating billions of dollars to different hedge funds. And basically, the only reason why they're actually investing in certain funds, they're not equipped to understanding which funds that they're supposed to invest in, because they don't have a PhD like myself or others who have PhDs or others that possibly work for a funds of funds. People that work for investment banks They get the job either through a friend or they're recruited, and they were recruited because they went to an Ivy League school. That's not a reason to qualify someone just because they went to a certain school. Secondly, if you do a list of the multi-billionaires, you will realize the percentage is greater of those people who didn't go to school or went to a mediocre school and didn't go to an Ivy League school. People who go to Ivy League schools, they get the best jobs at the best investment banks. Possibly because of who they are and what they're managing. That's why we had the collapse of 2008 and 2009. It was only Bank of America that reduced their exposure to certain type of products. Whereas Goldman Sachs is the best company. It's the number one, the top 5 companies in America. But yet they went bankrupt. And if it wasn't for Warren Buffett to fund them and keep them afloat while the markets were bad, they would be gone too. Whereas Bank of America was actually doing pretty good. Secondly, if these people were so sophisticated, then why didn't they reduce their positions in that type of market? Or, again, why didn't they reduce their positions in the cryptocurrency market? It just doesn't make sense, everything that happened. And as a funds of funds manager, the first thing you do is you analyze the returns and you're forecasting for the year ahead and 2 years ahead, etc. And so that person's either deselecting a fund for next 12 months or selecting a new fund, etc. based on the markets that are coming in the future. You will know this if you understand economics. You will understand which sectors actually do good in a slowing economy or a recession. You will know which sectors not to invest in, and you will know which sectors to invest in when they're at the bottom. There's a whole understanding that you have to have in economics. You need to understand politics, global politics, asset allocation. Now, just because you have 10 years experience at an investment bank allocating billions of dollars worth of capital, I've met some nasty people out there, and because they've managed billions, they have an ego trip beyond compare. So that ego trip, automatically you know that they're stopped learning, they haven't learned anything new. Secondly, because they think they know everything, and because they are a director at the investment bank, they think they're at the top of the world. Secondly, I guarantee you they're having issues with their marriage, just as most people do between their late 40s and mid 50s. It's just a normal time period that these things happen. And so their performance is being affected at the workplace. Secondly, they have stress at home and they have stress in the workplace because they realize that because as a director, after a director, where are you going to move up to? There's only a certain amount of positions that you can actually push yourself into and get rid of your competition to get there. And the fact is, the worst people actually move up because the only thing they're good with is getting rid of their competition. That's it. Because if they were actually good at something, then they would establish their own funds of funds, took their clients with them, the contacts, etc., and establish their own funds of funds if they were so good at what they were doing. And the fact is, they're not good at what they're doing because they're not positioning the investment bank to where it needs to be. 2008 and 2009 was a perfect example of this. The employee structure at companies has to change. This is why the hedge fund community, they produce an incredible amount of returns and high quality returns. When you call a hedge fund manager and you're one of their clients, you almost guarantee you're speaking with the company owner afterwards, after the market closes. And this is really important. You want that connection with the owner of the company and etc. And it's important for the owner of the company, the hedge fund manager, to have direct access to their clients, to be able to talk to them. Because honestly, only the trader knows what's going on and how to speak to people. This is why the smaller hedge funds will always outperform the larger hedge funds. Next, you have, because they're new in the industry, because they've worked through a market cycle, just because their hedge fund is only 5 years old, they were trading before 5 years, so they have a track record of, let's say, 10 years. Because in order to really get funded for a hedge fund, I honestly believe for an investor to invest in a new fund that just started, they need at least a 5-year track record, and one of those 5 years, you need to have worked through a market collapse and a trading sideways type of market. That's how you could tell whether or not this trader or that trader is actually going to be more proficient at managing capital. It has nothing to do with what they tell you, because they're going to tell you everything possible in a meeting. The Sam Bankman, that fraud, he had texted his friend. It seemed like they were only texting each other because they couldn't communicate. He texted a coworker and he said it was about raising a lot of capital or something to that effect, and the coworker says, great job, blah blah blah, and Sam Bankman goes, I told them exactly what they wanted to know. Exactly. So when you interview these people, when you're talking to these people, don't let them sell who they are. Don't ever do that. It's up to you to look at their returns and analyze them in the different type of markets. And that's the only thing you as the investor you're going to get. That's the only thing that you're going to get as an investor. Because talking to them, hearing them speak about their strategy, one, it's a lie what they're telling you, because they're not going to tell you their actual real strategy. That's private. And if they're telling you that, then guess what? Everyone in the industry could copy it. Two, they're going to tell you a sophisticated compilation of what they actually do. For example, I trade backwardation on oil futures. Well, the typical person is not going to know what that means. So they're not going to even question it. And they're not going to say, what is that? Exactly. And then, another question could be, well, is this risky? How is it not risky? They're going to tell you what you want to hear. Now, the best salespeople are actually people at the insurance company who sell basic insurance. And so you have to be very careful when you're interviewing these people or you're sitting down with them to put capital. The best thing is you shouldn't even bother sitting down with them, because it really is a waste of time. Because what's going to happen is, subconsciously, you are either going to invest in them or not invest in them based on your subconscious acceptance of their personality. And for the man, it's going to be whether you trust them or not. And for the female, it's going to be whether they're dominant or not. And so you have to understand psychology, organizational psychology, how women think, how men think. You have to understand everything. So you need to be very careful. And this is why I always say it's better to invest in a funds of funds that invest directly into a hedge fund. Now, the end of this video, I would like to go over something so as I mentioned, we need a lot more hedge funds trading capital. So 20,000, let's say, that's not enough. Because when you're allocating billions of dollars worth of capital, you don't want to be allocating $2 billion at a hedge fund, one company. And so if you have $1 trillion, that's a lot of money, meaning that you need a lot of hedge fund investments, an incredible amount that's not even out there. Because even if you diversify $1 trillion worth of capital, and you sort of diversify, let's say you invest no more than $2 million in each hedge fund. That's a lot of hedge funds to cover $1 trillion. So because of this, that there really is not enough, because it's a new industry, and it's an industry that's growing incredibly, because investing in the investment banks, your capital is not safe, number one. And number two, if you actually knew how to create your own hedge fund portfolio, you would actually make more money. For example, my hypothetical funds of funds, it has an average return just about under 30% per year. So if you take the last 5 years, and if you add up all those returns and divide it by 5, that average return is almost 30%. It's actually a little more. But because of 2022, that brought it down about 5%. So again, you also need to understand that you should have been investing in your commodities portfolio when the markets were doing really good. In 2018, 2019, you should have already been purchasing gold in your either ETFs or actually buying the physical gold coins. But if you have billions of dollars, it does become a little hard to store that. So you're better off buying the ETFs. And so what has to be done, the SEC needs to change the law that puts a cap on how much a hedge fund manager could raise. And this is very important. Now we know, based on my PhD research, that magic number is around 350 million. At around 350 million, a hedge fund's return will start to diminish. And around that time, you should be analyzing their returns to see if it's going to get watered down, to see if you have to remove them from your portfolio, etc. But there's a very small percentage, that because of the strategy that they're using and the type of markets that they're trading in, like 2020 or 2021, that type of market. And of course, in 2022, a very bad market, but it was different compared to 2020. So what you could actually do to be really safe, I personally believe that the SEC needs to pass a law and that there should be a cap on how large a hedge fund can be. Because if they do that, it will give a better opportunity for those kids out there that like trading and that have a 5-year track record and they're doing pretty good, that they could also have their own hedge fund. And they will have the opportunity to be established. So the more that we spread the money out to different traders, the more efficient the market will actually become. And for investors on that side, the more investors they will have to create a really proficient an extremely high quality return portfolio. Now for the large hedge funds, don't get upset with me, Mr. Griffin and Mr. Dalio, or Mr. whoever. What you should be doing is you should be giving the opportunity to the traders that you have on your trading floor, the opportunity to have their own hedge fund. You become the first investor to invest in them. No ownership you should get. Remember, you should be the first investor and you get a discount on the management fees. So instead of 22%, you could get they could charge you 10%, let's say, whatever it is. And what you could do, and I'm going to explain this, you could actually improve your overall average return. And so let's say that, Ken Griffin or Ray Dalio, let's say that they have 100 traders trading for them. I don't think it's that number. I think it's a little more. But the point is that if they have 100 traders trading for them, or 1,000, that's 1,000 hedge funds that they could establish. And Ken Griffin should actually be creating a funds of funds. All his investors should be focusing on investing in the funds of funds that Ken Griffin has or Ray Dalio has. Now, because you have 1,000 hedge funds in that you have 1,000 hedge funds trading the capital and the possibility to trade the capital, you could create a risk profile on each fund of funds. You could put in each fund of funds 8 hedge funds. That's the magic number, 7 to 8. The number actually is really not affected if it's 7 or 8. But what happens in a market that trades sideways, you really want to have 7 hedge funds trading for you. But when you have a market that's getting a little unstable, you really want to have 8 hedge funds in your portfolio. So it's all about forecasting the future. You need to know what the government plan is. So for example, if you know in 1994 that Bill Clinton was going to create the housing bubble, meaning he allowed the banks and his cabinet to lend money to anyone and make it easier, and he was also allowing banks to lend money to students to make it easier, so everyone went to college and everyone went and bought their own house, even though they shouldn't have. So, and there was no money down. So if you know this, and if you were doing portfolio analysis back then you could have actually prepared for the next 7 years, from 1994 to 2004, well, 10 years. And you would have known which hedge funds to invest in and create that funds of funds. And so as of today, how would you do that? Well, you know that the future is going to be manufacturing here in America and in every country possible. So every country is taking back their wealth. They can no longer borrow money to pay for their government bills, okay? They could no longer borrow money to get other governments to do what they want. That's an end now. The whole cycle has changed. So if you remember, during the war era of the 1930s and 40s, the government we'll lend you money, but you have to do what we want, and that's to buy our manufacturing goods. And so that's why we had the 1960s peak of the manufacturing in America. It was because Europe was stabilized. They didn't need to borrow so much money from America because they rebuilt as much as they could. And so by then, the US government was like, oh, we can't lend them money to get what we want. What do we do next? I'm not going to tell you what they did. You can watch in my other videos. But this is what the big hedge funds need to do. This is what every single hedge fund needs to do. Create a funds of funds and put your traders that you have in your funds of funds. Now, the issue becomes, so if you select, so for the funds of funds 1A, let's just call it funds of funds A. You select out of 1,000 hedge funds that you've created, you've funded, I should say. You could then match the risk profiling of the 7 funds together, and you could create 8 different matches, actually categories, 8 different categories. So let's just make it easy, 100 per category. You will be able to basically create 80 different funds of funds. And what you do, I don't want to give everything out, but it's just about risk profiling the markets that are coming. You have to also understand the future economics, which markets are going to be doing well, and what trader actually focuses on trading. You have an upper hand on actually doing this, you big, large hedge funds. Because since you know what the traders are doing, you know how to create a risk profile for each one based on what they're actually trading. And of course, you will have an incredible discount on those funds. So your funds of funds, if you charge 10% management fee, well, you're actually making more because you're getting a discount on each hedge fund. So this is very important for you to do. The employee structure is what brought down the investment bank. Because the traders at the investment bank, they're just an employee. They start them off when they're very young. They either start them off from an Ivy League school, they recruited them, or their friends gave them jobs, or uncle, or whoever it was. if they weren't from an Ivy League school. That's how you get the job there. You have to know someone. The funny thing is that everyone I know on the trading floor, almost 90%, they were all from Ivy League schools. And it's either they were recruited on the trading floor or they were actually a friend of someone that got them the job. That's not a reason to allow someone to trade. The most experienced people are not receiving what they should receive in this world. And it is up to you to find those gifted and talented traders. You need to focus on the junior high school kids. Start them off with a trading program, and you cultivate those young kids from there. You will see the ones that really persist, they will become an incredible trader. And of course, you could also put advertisements in the newspapers or online, and you could recruit traders that way. Recruit them when they're younger or older. Recruit them, and then out of 1,000 people, you make your selection. Give them the opportunity to trade. Give them the opportunity to actually have 5 years trading experience. Even if you have to hire them and give them a cheap employee salary, but give them the possibility to trade with fake money. Even if it's for 5 years, it takes 5 years to understand really how to trade. Not just your first couple months just because you're lucky. And a lot of people were lucky during the Bitcoin era, how everything went up so fast. So many people made billions of dollars, millions of dollars. But the fact is, those people are very silent now. It's because they lost everything. Because it is extremely hard to trade in a market that's either trading sideways for certain strategies or collapsing or going up for certain strategies. It just depends. And so that's up to you to create a balanced trading market. You won't have the disaster that happened at Steve Cohen's company. One of his traders was paying off people at other companies to find secrets about the company stock and what was going to happen. And so that's how he was making money. Steve Cohen could have went to jail for that. So again, you're reducing your risk with employee fraud because you don't employ that hedge fund. You are just an investor in that hedge fund. You will not lose all your capital under management for your funds of funds. You will alleviate yourself from that risk. And because I used to work for the trading floor of a big investment bank, I was the one who worked in data quality. Traders back then would cook their books, and it was the biggest secret going. So you could just imagine today, yes, a hedge fund can't actually cook their books. If they have an administrator, if they have a hedge fund accountant and an independent audit company come in. So it's a lot harder. Now the question is, why did Sam Bankman have that ability? That's the real issue. Again, I don't know everything, but what I do know, I would see a major change in your returns overall if you clumped certain hedge funds together to create a certain risk profile, and that risk profile determines your returns. Thank you so much. Please remember, if you like my channel, to subscribe. Anyway, if you do or don't, just do it. It doesn't hurt, because you're going to get my videos anyway. And please remember to do thumbs up. It doesn't hurt. It really helps me out. It's right there. Just press that little thumbs up button. Thank you so much.